Today I'm going to explain the difference between the standard deduction and itemizing your deductions, and when it makes sense to use one versus the other. There are a few situations where you are required to use itemized deductions. I will get to those later. If you're not required to itemize, then it always makes sense to use whatever number is bigger. If the standard is bigger, you use that. If your itemized deductions are bigger, you use that. Let me explain. Here is page 1 of your tax return, Form 1040. Lines 1 through 8 are your income sources. I input some numbers so you can follow the math. We have W-2 wages, we've got interest, we've got dividends, retirement account distributions, then we have capital gains, and here flowing in from Schedule 1, we've got real estate income and business income. We add all these up and we get your total income on line 9, $100,000 in this case. Now, it is very important to note that you are not taxed on your total income. You are taxed on your taxable income, which is on line 15. The lines between 10 and 13 are potential subtractions to your total income. That helps us arrive at our taxable income on line 15. Now, I'm not going to discuss Schedule 1 adjustments or the QBI deduction today. I'm going to focus on line 12, our standard deduction or itemized deductions. Now, you can see here that the larger the line 12 number is that we subtract from your total income, then the smaller our taxable income is. The less your taxable income, the less taxes that you pay. Now, the standard deduction is an amount that you can subtract from your total income and is purely based on your filing status. And it conveniently tells us what those standard deduction amounts are over here on the actual page of the 1040 itself. If you're single or married filing separately, it's $15,750. If you're married filing jointly or qualifying surviving spouse, it's $31,500. If we're head of household, it's $23,625. It is fairly easy to understand the standard deduction. Let's hop on over to itemized deductions. Itemized deductions are taken on Schedule A. Schedule A itemized deductions are two words for the same thing, right? Schedule A and itemized deductions, we're talking about the same thing. Important note regarding a frequent point of confusion. If you have a small business, itemized deductions have nothing to do with your business expenses. That is completely separate. Year after year, people tell me, hey, I have a small business, so that means I'm itemizing deductions. No, it has nothing to do with whether you're taking the itemized deductions or standard deductions. Yes, you're going to list all of your business expenses, which will lower the amount of business income that you pay tax on, but that has nothing to do with whether or not we take the standard deduction or itemized deductions. Let's skip to the end of Schedule A and work backwards. If line 17, your total itemized deductions are greater than your standard deduction for your filing status, then you're going to use itemized deductions. So in this case, $58,000 is bigger than any one of the standard deduction amounts for any filing status. So we know if we had $58,000 on our itemized deductions, we would use that instead of the standard. All right, so let's walk through Schedule A itemized deductions. Lines 1 through 4 are medical and dental expenses. So very few people qualify to use medical expenses as part of their itemized deductions, and the reason why is that only the portion of your out-of-pocket medical expenses that are greater than 7.5% of your adjusted gross income can be used. So you either need very high medical expenses or low income to be able to use these. For example, let's say your adjusted gross income is $100,000. 7.5% of that is $7,500. So only the medical expenses that were more than $7,500 would make it to line 4. Only the ones that are more. If total out-of-pocket medical expenses were $8,000, then $500 would be on line 4. If total medical expenses were $7,000, you would not list anything here. Important note, you can't list premiums here or any amounts that insurance paid for. All right, lines 5 through 7, state and local taxes, or SALT for short. This includes taxes you paid to your state or city, or general sales taxes like what you pay when you buy a car. It includes real estate taxes and possibly part of the annual vehicle registration fee. Even if you paid $30,000 in state and local taxes and $15,000 in real estate taxes, then the amount that we can deduct is still limited to $40,000 tops. We paid $45,000, but we cannot have more than $40,000 right here on line 7. And if your total income is more than $500,000, we start phasing out of this $40,000 amount, and we have to use a lot less. Up to $600,000 where it's completely phased out, and you are stuck with $10,000 at most. So let's say you're stuck with this $40,000 amount, even though you paid $45,000. Well, hey, we already know we're itemizing because $40,000 is bigger than any standard deduction that we can possibly take. All right, let's move on to lines 8 through 10. Interest you paid. The main thing that moves the needle here is interest and points that you paid on a mortgage loan for a primary or secondary residence. Also, if you borrowed money and used it to invest in the stock market or something else, then you might have deductible investment interest. And that is line 9, deductible investment interest. So let's say you paid $18,000 in mortgage interest. We would have $18,000 on this line, and if that's all the interest we paid, then we would have $18,000 on line 10. All right, moving on to lines 11 through 14. Gifts to charity. This is one of the most misunderstood areas in tax in general and probably on Schedule A. Year after year, clients come to me and tell me they made tax-deductible gifts to charity, and I have to tell them that since they are not itemizing, those charitable contributions don't help them reduce their tax bill. Your itemized deductions, which include charity, must be larger than your standard deduction for any of it to count. This is changing for tax year 2026. For tax year 2026, even if you are not itemizing, you will be able to reduce your taxable income with charitable contributions of up to $1,000 for single filers and $2,000 for married filing joint filers. Important note and planning point regarding the charities section. This is the section we probably have the most control over. We're not going to decide to pay more state and medical expenses than we need to, and SALT taxes or mortgage interest are fairly set in stone. Sure, you could potentially pay your real estate taxes early, and that might help. But with charity, you can give away $1,000 or $50,000, and it could make a drastic difference in your tax bill. Topics such as charitable bunching or donor-advised funds are important to consider. Moving on to casualty and theft losses. Also, not something you can really control. There are strict requirements to meet to have something qualify as a deductible casualty and theft loss. I may have seen line 16 filled out once or twice in the last 15 years of tax preparation, so this is not common. All right, so there we have it. If the total on line 17 is more than the standard deduction, this is what you would use. You would take the line 17 number and plug it in to line 12. So let's go back over to line 12 so we can follow along here. All right, so we're back looking at our 1040. And here is line 12. So we're going to plug in $58,000. And what that does for us is we would now take $100,000 and subtract $58,000 to get us to taxable income of $42,000. To summarize, if the total of your state and local taxes, mortgage interest, and charity contributions are more than your standard deduction, then you are itemizing. If you are not sure if your itemized deductions are greater than your standard, then you enter the information into your tax software or give it to your tax preparer and have them figure it out. If you are 100% sure that your standard deduction is bigger than your itemized deductions, then don't waste your time inputting your mortgage interest expense and your real estate taxes. For example, if you are married filing jointly and entitled to the $31,500 standard deduction, and you paid $2,000 in property taxes and $5,000 in mortgage interest, well, we know that $7,000 is a lot less than $31,500, so we know that the standard will be bigger and better. And I promise to tell you a few situations where you are required to itemize. You don't have a choice. Number one, probably the most common, is if you are married and filing separately and your spouse chooses to itemize their deductions, then you must also itemize yours. You cannot take the standard if your spouse is taking itemized deductions. And number two, if you are a non-resident alien or dual status alien during the tax year, then you are required to itemize. There are, of course, some exceptions. Hey, my name is Arash. I help people create plans to pay less in taxes. Did you know if you like, subscribe, and comment on my videos, you will automatically save 10% in taxes? Okay, that's actually not true. Also, I need to let you know that none of this video should be taken as tax advice. However, I would love to give you individualized tax advice. All you have to do is schedule a consultation on my website, link below.